Hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Well, looks like we are in for some midweek blues today as well, given the fact that we saw a 400-point reversal from intraday highs yesterday. So the Nifty ended below that 23,900 mark, and 23,800, that will be the key psychological level to watch out for. Just want to point out that the 200 DMA on the Nifty is at 23,530 or thereabouts, and the way we are falling, on the index, it looks like we are poised to test that level. Of course, we'll be touching base with our technical experts on the show and asking them as to whether or not we can look at a retest of 23,530 or thereabouts at lower levels, and where really are we headed from here. Because the pace of sell-off has been quite alarming. The two-day reprieve that we saw last week has completely fizzled out as, the focus has clearly shifted to earnings, and earnings thus far have been quite disappointing. It has been a washout quarter, and that is really playing out on Dalal Street as well. The sell-off was a little more deeper when it comes to the broader end of the markets, because even day before yesterday we saw a 1% cut coming in on the mid-cap index, and yesterday as well the cut was in excess of 1%. So yes, there is a lot of pressure, no signs of buying rather in any of the pockets, because all of the sectors were in the red. And this morning as well, the GIFT Nifty is hinting at a muted start, subdued start so to say. And if you look at the global cues, we are looking at negative cues there as well, because the post-election rally that we have seen play out on Wall Street took a pause yesterday. So yes, lots to watch out for, and of course we have that big debut on Dalal Street today. Swiggy will be making its debut, and it is expected to be a subdued listing given the kind of weak market sentiment at the current juncture. We'll also be talking about a lot of stocks that will be reacting to earnings, the likes of BSC, Nykaa. All of those stocks will be in focus. Of course, all your stock related queries will also be in focus. So if you have any queries, keep them coming in on our live feed. We'll try and take them up. But before we move any further, let's take a look at the top headlines then at this hour. First of all, the post-election rally on Wall Street has completely fizzled out, given the fact that the Dow in fact clocked in a 1% loss yesterday, over 300-point cut coming in there, and of course the CPI data will be watched out for the month of October. Asian markets also open with cuts following Wall Street peers lower. The GIFT Nifty of course hinting at a lower start for the Indian market as well. Crude prices hold near two-week lows. The Brent trades around that $72 a barrel mark, even as OPEC cuts demand forecast. Meanwhile, a stronger dollar also pushes gold prices to a two-month low around that $2,600 an ounce mark. Food delivery and quick commerce players Swiggy will list on the exchanges today. The 11,300 crore rupee issue saw muted demand and was subscribed over 3.5 times the shares on offer. And inflation spikes to a 14-month high as vegetable prices soar, goes beyond the RBI's upper tolerance band of 6%. Industrial output, meanwhile, expands by 3.1% in the month of September after contracting in August. All right, then, as I was mentioning, the Nifty, in fact, has slid to near 5-month lows. 4.5-month low is where the index is at. 23,900 has been violated. 23,800 would be the, closest support level to watch out for. And if it breaks below that, who knows, we could go ahead and retest 200 DMA levels of 23,530. 200 to 250 point cut, that can't be ruled out once we go below that 23,800 mark. Sectorally, as I mentioned at the start, all the sectors were trading in the red, but the big laggards were the entire PSU basket, metals pack, autos. These were some of the sectors that saw the most drubbing yesterday. And if you talk about the Nifty stocks, 44 out of 50 Nifty stocks ended the day in the red. Britannia, of course, hitting 5-month lows on the back of weak show in the second quarter. I beg your pardon. NTPC also was the top loser. FMCG pack was under pressure, of course, on demand concerns and concerns over slowdown in urban consumption. That's the trend that has played out. If you've seen all the FMCG numbers. Advance decline ratio was very poor, 1:4 on the NSE, and which is why the breadth was extremely poor, and the mid-cap index, of course, saw a cut of over 1% or thereabouts. The Nifty put-call ratio dropped to 0.72 levels vis-a-vis 0.9 levels in the previous session. And talking about the stocks in the F&O band, no new additions or deletions, but four counters. In fact, I think five counters in F&O ban today. The likes of Manappuram Finance, Aditya Birla Fashion, you have Granules India, Aarti Industries, as well as Hindustan Copper. Well, FIIs, they continue to sell the press button. So they have sold shares to the tune of 3,000 crore rupees in the cash markets yesterday. Remember, the dollar index is coming very close to that 106 handle, which is why a lot of these emerging currencies are also under pressure. And rupee, of course, hitting fresh record lows every single day. But on the flip side, you had DII net buying support coming in. 1,854 crore rupee worth of stocks were bought in the cash market. But on that note, let me bring on board our technical expert for today. Let me check if Rajesh is there or not. Rajesh Palviya of Axis Securities joining in. Rajesh, great to have you on the show, but the mood is pretty somber, right? 23,900 violated, 23,800, at risk of being taken out today. But once we take out that 23,800 mark, would you expect a retest of the 200 DMA level of 23,530 or thereabouts in the coming sessions?
Good morning, Nandita. So looking at the supply pressure, intense supply pressure from the FII, that clearly shows that, still there is no sign of reversal, and the way short built-up is there in both the indices, we believe that, yes, there could be a further sell-off. We can see if he breaks below to 23,800, though market is oversold on the near-term, short-term structure, but the way supply pressure is coming from the FIs, that clearly shows that, yes, if he breaks below 23,800, there is a possibility that, we may slip towards the 200-day moving average. And I think the next major support area or the level where Nifty can slide is 23,500 to 23,300. That's the next level where Nifty may, slide further if we sustain below to 23,800. So at this moment, 23,800 is the key level to watch for. If we, slip further in the today's session. Even on the Bank Nifty also, there was some outperformance in Bank Nifty, and Bank Nifty was trying to hold at higher level. But in the last two trading session, again, there is a supply pressure in Bank Nifty also, and are not able to hold out above 51,500. So I think if it's sustained below to 51,500 level, there is a possibility that, Bank Nifty may also slip further towards 50,600. That's the next major support area for the Bank Nifty in the continuation of this down move. So both indices are looking bearish. Short built up is there in the previous day for both the indices. So I think sell on rise is the strategy until the Nifty not crosses about 24,200 on a closing basis. I think whatever minor pullback if we get in market should be used as a shorting opportunity. Even for Bank Nifty, 52,000 is the key level at this juncture. Until these level not crossed, I think minor pullback should be used as a shorting opportunity in the Bank Nifty also.
Okay, bearish signals emerging from the charts of the Nifty as well as the Nifty Bank Index. But I also want to point out it's the last weekly expiry of the Nifty Bank Index. After this, we'll only have monthly expiry on the Nifty Bank Index. But let's talk about specific stocks then. I want to talk about the PNB housing, given the fact that we are expected to see a block deal in this counter. Just want to go through the details. Quality Investment is likely to sell somewhere around 9.5% stake. Offer price is at 913, a little over 939 rupees a piece, which is at a discount of over 4% to yesterday's close price. There will be a 60-day lock-in period for the selling shareholder post this. And if you look at the entire holding that Quality Investment held or had in PNB Housing, that was at close to 20%. So their stake will come down by almost 10% in this stock. PNB Housing in the last 3 months has given decent returns, but I think the up move has lost some bit of steam in the last 1 month. It is sub 1,000 levels right now, particularly for today. Given the supply pressure, what kind of a level would you watch out for here? Would you expect 900 to be taken out?
So stock is in uptrend and a short to medium term structure. Yes, looking at the market condition, yes, there was some profit taking at higher level, and now stock is struggling to cross again. It's a 50-day moving average, which is placed at around 1,000 kind of level. So I think 1,000 is the steep resistance at this juncture. On the downside, 950 is the immediate level. If it's remain below to 950, which is 20-day moving average, if it's sustained below to 950, yes, there is a possibility that the stock may retest to the it's a previous swing low around 900 or 890 kind of level. If if it's sustained below to 950, so 1,000 rupees to 950 is the level at this juncture. One needs to look at this 950. If it breaks, yes, there is a possibility of 900 level.
Okay, that's the view on a PNB housing. What would you really do with Britannia, Rajesh? Yesterday, the stock slipped to a 5-month low. It was the top Nifty laggard. Of course, the entire FMCG pack seems to be under pressure. Of course, we are talking about the theme of urban consumption slowing down. That's the kind of trend that has emerged from FMCG earnings. What would you do with some of these counters now?
So definitely most of the FMCG stocks are, under supply pressure, and the way Britannia has broken down its, immediate support area of 5,400 level, and now the way stock has broken all its monthly, weekly support area, stock is in bearish trajectory for short to medium term also, and the way stock has fallen in this current week, we believe that if it's sustained below to 5,100, 5,150 kind of level, we could see further more follow-up selling, and possibly stock may slip further to 4850 kind of level also. So structure is very weak for the Britannia, and I think until the stock not crosses 5150, I think one should use any minor pullback to be as a shorting opportunity in derivative side. Lower side target 4850 we could see in the near term to short term perspective.
All right, that's the view on the FMCG stocks, particularly Britannia. Sell on rise. Take it as a shorting opportunity if you see any up move on the derivative side. But just about 4 seconds to go for the markets to open. Of course, it is expected to be a weak start, but whether or not we take out that 23,800 on the lower side is something that we'll be watching out for. The first ticks coming in just about clutching on to that 23,800 mark. It's a 75 to 80 point cut. We have slipped below that 23,800 mark as we speak, and the Sensex as well down 200 points. The mid cap index is seeing sharper cuts, another 0.5% cut coming in there. The bank Nifty, the mild cuts right now, but let's see how trade really pans out for the Nifty Bank Index. As I mentioned, it's the last weekly expiry on the Nifty Bank Index, so that will be one index to really watch out for today. It has broken below that 51,100 mark, but let's see whether 51,000 holds or not. But in terms of other sectors, just want to see if there are any sectors that are trading in the green, because right now it's a sea of red. No sectors trading in the green at the current juncture. Autos continue to languish, another 1% cut on the auto index. You have FMCG as well, 0.4% kind of cut coming in there. The PSU Bank Index down another 0.8%. All of the sectors trading in the red. Realty down 0.7%. So yes, IT, metals, no pocket of safety, or pockets that have come to any kind of rescue for the market at the current juncture. Sea of red. And in terms of individual movers, just want to see, how many stocks are actually gaining in such a scenario. M&M is the top laggard. Maruti is the next one. Shriram Finance, Nestle, Hero MotoCorp, BPCL, Eicher Motors ahead of numbers. Titan, Apollo Hospitals, all of these counters trading in the red. What's doing well in a weak market is NTPC. The NTPC Green India IPO will be opening up for subscription sometime soon. And they have set the IPO price as well. I think it's at 102 to 108 rupees per share. That's the IPO price band. The 10,000 crore rupee IPO will be opening on the 19th of November and will close on the 22nd of November. So, given that we've seen NTPC trading in the green, Bharti Airtel is doing well. HDFC Bank, by the way, which was a laggard yesterday, is trying to give some support to the index. Tata Motors, Asian Paints, Infosys continues to do well. Power Grid, Kotak Mahindra Bank, HCL Tech and ICICI Bank, these are some of the few gainers that we have in today's session. Bank Nifty, by the way, has managed to edge back into the green. So yes, there is extreme choppiness at the start. We have also pulled back from the opening lows. We are above that 23,850 mark as we speak. So yes, it is fairly choppy, but perhaps after a couple of hours of trade, we'll see which way the market direction will really pan out for today. But Rajesh, I keep getting queries as to where or which pocket should one really invest in at the current juncture. I think Praveena Jain has written in on our feed, and she wants to know which is the sector that's looking good for investment now. So guide her on that, as well as take us through which are the stocks that you would be recommending for viewers for the next couple of sessions.
So most of the sectors have corrected significantly in this recent down move, which we are seeing in last couple of months. But the sector for near-term to short-term perspective, for trading as well as for short-term investment perspective, which we are focusing, that is IT as well as the pharma. These two sectors are looking still stronger compared to all other sectors. So I think some of the stocks from IT space are looking attractive. One can focus on HCL Tech, Wipro, as well as Infosys. These three stocks are looking attractive from the large cap IT space. And from mid cap IT, that is Coforge is our preferred choice from mid cap IT space. From pharma space, I think one can focus on stock like Lupin, Ipca, as well as Divi's Lab. These three stocks are looking promising from pharma space. Even from healthcare as well as from the hospital segment, I think Fortis Healthcare is another stock where we are bullish for near-term to short-term perspective. So I think these all stocks can be looked at for near-term to short-term perspective. But again, on the investment point of view, I think a lot of space has already corrected significantly. But again, as market structure is still not recovered, so if you wish to buy on a staggered manner, a lot of space from different sectors are looking very attractive. The stocks which have already corrected from their recent high are looking promising. The stock like from the banking basket, I think Bank of Baroda is looking attractive. From the PSU banking basket, I think these stocks can be looked at for buying on a staggered manner. And we believe that once markets stabilize, I think from the PSU banking basket, Bank of Baroda can be a stock where we can see good run up going forward. Again, the stocks from the real estate space, one can look at stock like Godrej Property. That stock is also corrected from its recent swing high. And the way stock has corrected, I think the important level on the downside for Godrej Property is around 2,500. So if its stocks comes around those level, one can start buying on a staggered manner. Here also there is an opportunity. Once market stabilize, this stock also start recovering from the recent low. From consumption basket, I think from FMCG basket, I think Indigo Paint is our preferred choice from that space. Stock is trying to recover from its recent swing low. The way stock is consolidating on a monthly chart, we believe that once stock crosses over 1600 level, I think there is a possibility that this stock can also deliver good really going forward on an investment perspective. So Indigo Paint is again our preferred choice from this consumption as well as from the FMCG pack. And from insurance space, I think one can focus on HDFC Life. This theme is also looking attractive. Despite of this supply pressure, HDFC Life is showing a strength, and we believe that this stock has potential to go further higher towards 800 to 850 zone on a 12-month to 15-month time frame. So this stock can be also looked at for buy and accumulate kind of strategy. Your stop loss should be placed at around 620.
All right, a whole host of pockets and stocks that Rajesh spoke about. Praveena, I hope this answers your query. But let's talk about specific stocks then that are reacting to earnings. Rajesh, Nykaa, good set of numbers coming in. Profit saw a 65% or 66% jump, and revenues were also in excess of 20%. In fact, near 25% growth, and margins have also seen an uptick. The stock is up somewhere around 4% or thereabouts. Do you see 200 being cleared soon? What's the sense you're getting?
So after correction, since last 3-4 weeks, stock is trying to hold out the lower band of support around 170-75 zone. I think if it's able to hold out 175 level for next couple of days, I think there is a possibility that stock may attempt to give some further more pullback towards, yes, 200 is the next level where stock may attempt to give a pullback. If it surpasses 200 level, I think then there is a possibility of 220 would be the next target. So at this juncture, yes, one can hold on their long position. Fresh long can be deployed with stop loss of 175.
Okay, keep a stop loss at 175 on Nykaa. That's the view. Let's talk about the BSE then. Numbers were strong. Profit has seen a threefold jump. Revenues also almost doubled. And Jefferies has come out with a report on BSE where they've kept an underperform call. Target price is at 3,500, which is another 1,000 point off, over 1,000 rupees off where the stock is at the current juncture. Jefferies has noted that, the focus will be on the volume impact from SEBI's new F&O guidelines. And, Jefferies has also pointed out that the risk reward remains, unattractive or unfavorable for BSE. Would you concur with that? Because, the stock has seen a good correction, although it is a multi-bagger stock. Last 6 months, it has given returns of 75% or thereabouts, but it has also seen a fair bit of correction. Would you still call the risk reward unattractive here?
So definitely after this weekly option expiry curve, I think yes, there would be hit on exchanges volume. But again, on the other side, the volume will shift on the cash segment because those who are trader in nature, they will look some opportunity in the cash segment also for day-to-day trading perspective. So that volume may shift to the cash segment. But again, it's early to say, and we have to wait and watch for next couple of months how market try to adjust all these changes which is going to take place by this 19th of November on the weekly option expiry. Looking at the technical structure of BSE, yes, definitely stock structure is still on the bullish side, and the way stock has run up in last couple of months, we still hold our bullish view based on the technical front. 4,500 is the immediate supply zone for the immediate support zone for the stock at this juncture. And I think till the stock is holding above 4,500, 4,450 kind of zone, I think trend is likely to remain on the bullish side. So 4,450 should be your stop loss if you are holding the position, as market is still under supply pressure. So I think one should trail their stop loss around 4,450 to hold their long position. And I think till these levels are intact, the trend is likely to remain on the bullish side, and on the higher side, 4,650 is the immediate supply zone. If it crosses those level, possible rally can extend also, because in this kind of market, very few pockets are holding the ground at higher level, and BSE is one of the stock that stock is almost trading near to its all-time high trajectory. So I think once market stabilize, I think outperformance is likely to be there. So this is purely based on the technical basis. Maybe yes, in next couple of months again, Street is going to observe what kind of volumes and what kind of business they are losing because of this F&O curve. So that would be interesting to see in the next couple of months.
Okay, that's the view on BSE. Another counter I want to get in your thoughts on is Bosch. Reacting to its earnings, the stock is up 3.5% or thereabouts as we speak. The numbers came out yesterday, post market hours. Profits were down somewhere around 47%. Revenues, however, rose 6.5%. Margins also came in higher, by almost 90 basis points or thereabouts on a YY basis. We have a query also coming in on our feed from Debu K as to what one should be doing with the stock. The stock has been under a fair bit of pressure off late, if you look at the monthly charts. But with today's move, do you see any kind of reversal?
So stock is in downtrend and series of lower top, lower bottom formation in the stock on the near term daily chart. Since last 4-5 weeks, there is a sustained supply pressure in the stock. Looking at the near-term, short-term structure, as the stock has already broken, it's a 35,000 level, which is the major important key support area for the stock. So I think till the stock is not able to regain about 35,000 level, I think trend is likely to remain on the bearish side. And once the stock breaks below 34,000 or 33,900 kind of level, I think we may see further more supply towards 33,200 to 33,000 level also. So still trend is on the weaker side. Yes, some pullback is coming, but 35,000 level needs to watch on this pullback, whether the stock able to cross this level or not.
Okay, that's the view on Bosch. Hope that answers your query. But the other one that will be in focus, and that's been in a correction phase, is Zomato. Rival Swiggy is making its debut today at 10 a.m. and it is expected to be a muted or subdued listing, so to say. The GMP is signaling that, and the market sentiment is also fairly weak. But in light of Swiggy's entry, any impact or any further levels that you're watching out for on the downside on a Zomato? And would you advise people who have holdings in Zomato to buy more?
So I think in this correction, stock is able to hold a 100-day moving average, which is the important level for this stock on this correction. Though stock has shown some recovery in last couple of trading session. Looking at the near-term structure, the immediate supply zone for Zomato is placed at around 270-75 zone. If stock crosses those level, I think then yes, really can extend further to 290 to 300 level also. But it may take time as the market structure is not that much great at this juncture. But I think those who are already holding the position and they have view for holding it for for a little longer period, yes, they may hold on the position as a structure for long term structure is still bullish. 240 should be your stop loss if you are holding the position.
Okay, 240 important level in terms of stop loss to watch out for on Zomato. But next query on HDFC Bank, shares are trading higher today, but we've been waiting for the stock to really cross that 1800 level decisively. Of course, the 52-week highs are is perched at 1794 or so, but given the fact that the stock has managed to give positive returns in the last 1 month, and going by the current trends, would you look at 1800 anytime soon? And if yes, what should be the time frame?
Though HDFC Bank, if we compare with all other banks, I think if we analyze from the all-time high trajectory, still stock is comfortably trading at a higher band of its rally, which we have witnessed in last couple of months. Looking at the near-term, short-term structure, yes, stock is struggling to cross its immediate resistance zone of 1760, 1770 zone. I think once stock crosses above 1770, yes, there is a high possibility that stock may attempt to cross 1800 and then beyond really can extend. But till the time stock not crosses 1770, we may see some consolidation in very tight range of 1690 to 1770. This is the range. So I think those who have long-term, investment horizon, they can buy and accumulate this stock. Yes, definitely on a longer term perspective, this stock is going to deliver good return on from this banking space. But yes, it may take time. So 1690 to 1770 is a buy and accumulate range. Your stop loss should be placed at around 1640. But this is purely for investment perspective or for medium term to long term. Definitely, stock may cross 1800 and then really can extend to 1900 level also on a long term perspective.
Okay, this query was, I think, from Hemant. Hemant, hope that answers your query. But the next query I spotted on a GR Infra. This gentleman is Puneet Rajiv, and he's been holding on to it since 2 years at IPO level. GR Infra, what would you advise him to do now?
So there was an attempt of recovery, but again on 1800, there is a steep resistance for this stock in this recovery. Since last a couple of weeks, there is supply pressure in the stock. In this process, stock is now slipped below to 20-day moving average. So 1600 is the immediate supply zone for the stock. If it's sustained below to 1600, I think there could be further more follow-up selling in the stock. On the downside, 1485 is the critical level for the stock. If it breaks below 1485, I think then fall can extend to 1400 level also. So I think if you are holding the position, 1485 should be your stop loss if you are holding the position.
Okay, that's the view on GR Infra. Hope that answers your query. Last query for today then. This one's coming in from Raj Nihalini. And he wants to know your thoughts on a Tata Elxsi. This stock has been stuck in a downtrend, even on YTD basis and 1 year basis. The stock has given negative returns, stuck in a downtrend, and hasn't really seen any kind of a reversal. So, for those who have some kind of holding on Tata Elxsi, what would you advise them to do?
So, Nandita, I think stock is still in corrective mode. Though stock is in correction since last couple of months, there is no as such significant reversal we have witnessed in this stock. I think in this correction, the major support zone for the stock is placed at around 6,200 to 6,000 level. I think that level needs to watch in this correction. If it's able to hold a 6,000 level, I think some average buying one can deploy those who are already bought at higher level, because though long-term structure for the stock is still on the bullish side, but on the short to medium-term structure, some correction is still going on in this stock. So I think my advice would be try to average out around 6,000 level. That's the important support area for this correction. Or one can review around 6,000 level. If it's hold, some average buying can be done. On the higher side, 6850, 6900 are the immediate supply zone or the resistance zone. Once the stock crosses above 6900 level, rally can extend to 7500 to 7800 on a short term basis.
All right, that's the view on Tata Elxsi. With that, we've come to the end of the query segment. And Rajesh, would like to thank you for taking out time and joining in as usual and sharing your thoughts with us. Always a pleasure interacting with you.
Thank you.
Well, with that, the markets, of course, around just about hovering around that 23,800 mark. Let's see how really trade pans out, because it is still an 80-point cut on the index and not looking that pretty. It's a sea of red across the screen. But on that note, let me also bring on board Rishi Kohli, who's the CIO, Hedge Fund Strategies at InCred Alternative Investments. Rishi, pleasure having you on the show today. Let me first begin by asking you, what are you making of the kind of sell-off and the pace of sell-off in the market, right? We are over 2,000 points off record levels, and crucial levels of 24,000 also being taken out. Any level that you have in mind? I know you don't really track level wise, but by year end, would you expect 23,000 to be taken out? I mean, what is your sense looking at the pace of the sell-off?
Yeah, great to be on the show. So the sell-off, I think this time is very different from whatever we've seen in the last 1.5 years. And the way it has initially come down is more reminding me of how the decline had started from October 21. So if you remember, October 21 to March 23, almost that 1.5 year period was a very difficult period for the markets overall. And it had declined, and then at the headline level the damage was lesser, but stocks the damage was more. Mid cap, small cap, the damage was more in that period. And because it extended for 1 to 1.5 years, obviously the pain was felt a lot more. So the way this current decline has started over the last 1.5 months, is very similar on many counts of whatever patterns and cycles and other quant things we look at to that period. Having said that, breaking it down into smaller, movements and targets, as you asked. So 23,300 on the Nifty seems like an immediate level. There are many other patterns that have formed to which are giving that target, and the fact that it did go down below 24,000, 23,900 levels today is probably a day where if it sort of recovers, manages to recover towards the end, and tomorrow weekly close is again above 23,900 or 24,000 levels, then maybe for the near term, that decline could be avoided. So I think today, tomorrow is important from a short term perspective. But in the sort of 2-3 month perspective, I have no doubt that we will see 23,300, we will see 23,000. So those levels are very much there. There is a seasonality effect. So post mid-November till around first week of January till New Year, markets do have a tendency to bounce. So if we manage to recover today, tomorrow, or we hit those levels very quickly in some sort of a panic day, then I would expect from there till New Year to be positive. But then Jan, Feb again, typically very volatile, very difficult markets in those months, even in bullish years. So I would expect if a quicker recovery happens, that Jan, Feb again, you will see a decent decline. So overall, I think a cautious period till mid-March, I would say, is the way I would look at it. And therefore, selectively going into selective sectors, doing sector rotation, hedging your portfolios, going into more balanced allocations or long short kind of allocations. I think all of that makes a lot of sense for the next few months.
Okay, so would you be sitting on cash at the current juncture and use any rallies to exit? How should you really approach for those whose portfolios are actually bleeding in this leg of the sell-off? How should they approach?
Basically, this is a time for reallocation. So, sectors like IT and other sectors which are looking a little more relatively stronger. So IT comes top of the mind. Even pharma and some sectors like metals and are doing something slightly different. So obviously metals are volatile and can come down sometimes with a lot of volatility. But in this cycle, they are doing something slightly different. They do look relatively stronger compared to other cycles where market weakness was seen. But in terms of pure market strength, I think IT definitely is standing out at this juncture. So some reallocation of sectors can be done if people have direct portfolios. On a sort of an overall mutual fund allocation level, I think, being in balanced funds or more, lesser risky funds than equities makes a lot of sense. We manage long short hedge fund strategies, AIF funds, right? So things like that, with very low risk can give you consistent returns. I think the next 6 to 12 months could be more interesting for such things.
Another point I want to bring up is the the slowdown in urban consumption. That's the theme that has emerged across sectors like autos as well, FMCG of course, and we saw stocks like Britannia, HUL reacting sharply to that. How would you really look at some of these FMCG names? Is it time to steer clear of them? Because inflation once again rising above 6%, that's another setback, right? So here on, are these sectors a total avoid at the current juncture?
So see, I mean, some of the sector has declined in advance to these numbers, right? So obviously the numbers have come out now and are sort of worse than expectations. Obviously, a lot of these stocks trade at very high multiples, as we all know. So, even a slight disappointment is cause for concern. Having said that, as you said, overall consumption has been lower. All of that, from a structural perspective, is also looking a little tougher in the near term, at least. So from that angle, yes, I mean, they are definitely FMCG, auto are not coming in the top few sectors when we run our sector rotation models every month, every quarter, we update them. So yes, I would stay away from them. Having said that, because these sectors also started declining sort of before the market, right? So if you see, they actually started declining. They were sort of giving that indication earlier. So from that angle, some trading rallies that will come and short-term bounces that will come in between, like I talked about of the seasonality thing, I think some of that could happen in some of the subsegments. So wherever relatively in these sectors, the numbers have been better, earnings have been better, or fundamentally there are some other attractive factors, then, those stocks would selectively maybe bounce a little better in some of these trading rallies that come once in a while. So that is how I would use them. But from a overall medium term perspective, yes, I mean, they would not rank very high in an immediate term.
Okay. What do you make of the recent listings that we've had, the likes of Hyundai and of course Swiggy is also making its debut today. In light of that, anything that has caught your fancy, and how would you really approach Zomato now that Swiggy is also making its debut on Dalal Street?
No, so I mean, a lot of the recent issues, I mean, especially the names you mentioned have, not been super attractive anyway from a fundamental level, especially at the levels at which they were listing. So from that angle, not very exciting from a listing perspective and an immediate term perspective. Zomato, Swiggy, of course, that relative comparison keeps coming up. But I think again, sort of the immediate market impact will be seen even in these stocks. Post that, of course, I mean, on a relative basis, I think Zomato is a little stronger, in my opinion, to Swiggy. But yeah, overall market decline will impact that too.
Another question on, the rupee weakness. Of course, it has been hitting fresh lows consistently, and, companies relying on foreign borrowing face greater challenges in accessing credit, right? So how will, that impact industries that rely heavily on imports? You spoke about pharma seeing good traction, or, perhaps you could look at opportunities in the pharma space. But don't you think the rupee weakness would actually pose a headwind to the pharma space as well?
Yeah, so near term it could, but as you know that rupee anyway in the longer term, has had that depreciating sort of slope. So I think stronger companies in the sectors where the currency impacts them, I think they have over time with experience and understanding, I think they're able to handle that reasonably well in terms of whatever forex hedging or other treasury solutions they can use to dampen that effect. So from that angle, in the medium to long term, I would not be that worried. And of course, the rupee has been very, very stable. RBI has kept it very stable over time. The only worry is that, when it is sort of in a very tight band, any currency globally, when it is in a very tight band for extended periods of time, and obviously that is due to central bank or government sort of intervention or outlook on how to manage the currency and the forex reserves. Then typically whenever a stressed situation comes, then there is a shock and a sort of a stair-step function where it suddenly moves sharply, at least for a few weeks or a month, and then again settles down. So that is the only thing I would be worried about from the currency perspective. Otherwise, gradual movements here and there overall will not really impact because the companies know how to handle that. In the near term, of course, there's no cause for that macro worry also, because I think everything is broadly looking good on the macro front as such. So I would not be worried about that. There's no 2013-14 kind of situation possible at all. But at any point in time in the future, whenever there is some stress on any of the macro factors, then I would be more worried about all of this. Not right now.
All right, point taken. And lastly, what should be the ideal asset allocation strategy now? In a bid to really hedge your portfolios in times of, sell-off. How much should one be exposed to debt securities now?
So, like I said, till March, I would be cautious at least. And if it extends like the October 21 to March 23 period, then, maybe a little longer, maybe another 6 months after March also. So it'll all depend on how it plays out till March. But yes, till March, definitely cautious. And from that perspective, obviously, having, even 50-60% or more, depending on, what your current asset allocation is. So if currently it is more like 80-20, 80 towards equity, then I would say, it needs to reverse and go 50-60% to debt or debt-like allocations. So when I say that, it could be, arbitrage funds. It could be, like I said, long-short funds, because these are, and I run one long-short fund, right? So these are things which are basically categorized as absolute return funds and, try to outperform short-term bond funds and arbitrage funds while keeping the risks almost zero. I mean, almost very, very minimal. You can't say zero, but very, very minimal. So things like this, of course, those are for HNIs and larger investors. But for those who can, I think those absolute return alternative investment funds make a lot of sense. For others, having more allocation to debt, but within debt, having more sort of higher yield debt with lower risk. So arbitrage does that. Some balanced funds which can do that potentially. So I think all of that makes a lot of sense. And then, of course, that also means that you're much more liquid. And if a sharp panic or crash happens at some point, then you can again reallocate back into a larger allocation into equities. So those couple of mixes is what I would.
Sure. And any thoughts on Bitcoin? Has cleared that $90,000 mark as well. I mean, the Trump trade really playing out there. What are your thoughts? $100,000?
Yeah, so obviously from an investment perspective and otherwise, whether at a firm level or personally, obviously we are not trading Bitcoin as such, but just from a technical and a quantitative perspective, yes, because it's become so liquid and so large and part of conversations everywhere around the world, we do track it. And in fact, that breakout above 70,000 when it had happened, there was a clear target of around 100,000 that was coming. So I think it's just, moving in line with that. I think there is another 5 to 10% remaining at these levels. But at that 100,000 levels, there would be some significant resistance. But overall, interestingly, the patterns that have formed, are pretty bullish in the near to medium term.
All right, Rishi, I'm afraid that's all the time we have. Great to, get your insights on a range of topics, and I look forward to interacting again with you sometime soon and hope the mood will be a little better than what it is right now.
Great to be on the show. Thanks for having me. Bye.
Thanks a lot. Well, on that note, of course, the sell-off has deepened. In fact, we are staring at 23,700 being taken out anytime. A 160-point cut on the index, and Sensex, of course, is also down somewhere around 400 points or thereabouts. The mid-cap index is down almost 2%. So the broader markets continue to face investor ire, and the advance decline ratio is dismal to say the least. 1:8, that's the NSE advance decline ratio. Just about 255 stocks advancing to 2,060 declining. So yes, the sell-off has only deepened, and of course, broader markets are facing the heat. Bank Nifty that had managed to edge back into the green is once again back in the red, and gainers are few and far between today, and lots of losers. The likes of BEL, PSU names as I can spot on the list. Auto names, metals, it's a bloodbath, so to say, and 23,700. Now we are staring at that level, and if that gets taken out, who knows? 200 DMA levels of 23,500 or 530 or thereabouts could be tested once again. So yes, the mood is not all that great, and it is a sea of red across the screen. But with that completely timed out on this edition of Opening Bell, thanks a lot for tuning in. Have a great day, and of course, come back and join us again on Closing Bell. Thank you.